At Sure Dividend, we advocate for taking a systematic approach to dividend growth investing. This means that our stock selection process is grounded in a quantitative, rules-based approach to identifying individual securities. In today's video, I'm going to share with you the 8 rules of dividend investing, which is the security selection process that we use to pick individual stocks for the Sure Dividend newsletter. To begin, I wanted to provide a brief summary of the 8 rules of dividend investing. The system is split into 3 categories. First are the 5 buy rules. These rules help you to identify which stocks to buy. Next are the 2 sell rules, which tell you when you should part with stocks that you already own. The last rule is our portfolio management rule, which tells you how many stocks you should own at any given time. We'll dive deeper into each of these rules throughout the rest of this video, starting with the first buy rule, the quality rule. The quality rule is based on the belief that you want to invest in high-quality businesses with proven track records of growth, stability, and profitability. To capture this belief quantitatively, we rank stocks by their dividend history and their corporate history. This means that stocks that have existed longer will rank higher in the system, and it also means that stocks with more years of consecutive dividend increases will also rank higher in the system. The empirical evidence that supports this rule can be found by looking at the performance of the Dividend Aristocrats Index. For those of you that are unfamiliar with the Dividend Aristocrats, they are a group of dividend stocks with 25 years or more of consecutive dividend increases. The Dividend Aristocrats have outperformed the S&P 500 by 2.9% per year over the 10-year period ending May 31st, 2018. The second buy rule of the 8 rules of dividend investing is the bargain rule. The belief here is that we want to invest in companies that pay us the most in dividends per dollar that we invest. To capture this quantitatively, we rank companies by dividend yield, with higher dividend yields being better. In addition, we only recommend stocks that are trading below their 10-year average price to earnings ratio, which prevents us from recommending overvalued stocks with lower dividend yields. The academic evidence that underpins this buy rule is presented by Heartland Funds in a study where they found that the highest yielding quintile of dividend stocks outperformed the lowest yielding quintile of dividend stocks by a remarkable 1.76% per year between 1928 and 2013. Moving on, we'll discuss our third buy rule, which is the safety rule. The safety rule is based on the belief that we want to generate recession-resistant dividend income. In other words, there needs to be a significant margin of safety in the dividends that we receive. If a company is paying out all of its earnings as dividends, there is no margin of safety, and the dividend may be cut if business conditions worsen. We capture this effect by investing in companies with high share repurchase yields. What this means is that a company is buying back a lot of stock, and it's likely to stop buying back stock before it reduces or eliminates its dividend. The academic evidence to support this rule comes from the S&P 500 Buyback Index, which contains the 100 companies within the S&P 500 with the highest share repurchase yield. This group of companies has outperformed the broader investment universe by 3.4% per year over the last 10 years. Moving on, the fourth buy rule is the growth rule. The growth rule exists because we want to invest in businesses that are growing faster than the broader investment universe. The way that we capture this effect quantitatively is by ranking stocks by their long-term earnings per share growth estimates. The academic research that underpins this rule is powerful. Research from Oppenheimer has shown that dividend growth stocks have outperformed non-dividend growers by 2.4% per year between 1972 and 2013. The fifth rule of the 8 rules of dividend investing, and the final buy rule, is the peace of mind rule. The peace of mind rule exists because we want to invest in businesses that people are happy to buy during times of recession and economic panic. This results in lower stock price volatility, which makes the businesses much easier to hold over long periods of time. To capture this effect quantitatively, we rank stocks by their long-term volatility and their long-term stock price beta. The academic evidence for this rule comes from looking at the performance of the S&P 500 Low Volatility Index, which contains the 100 stocks within the S&P 500 with the lowest stock price volatility. This group of stocks has outperformed the broader S&P 500 by 1.4% per year over the last 10 years. That concludes our discussion of the 5 buy rules that we use to identify stocks at Sure Dividend. Moving on, we'll now discuss our 2 sell rules, starting with rule number 6, the overpriced rule. The overpriced rule simply states that you want to sell a stock if it becomes irrationally overpriced. If you're offered $500,000 for a $250,000 house, you take the money. The same principle holds with stocks. The problem with this approach is that overpriced is a subjective measure, and it needs to be quantified somehow. The way that we address this problem is by assigning a fixed price to earnings ratio at which we will sell a stock. More specifically, our system recommends selling a stock when it reaches a price to earnings ratio of 40. The academic evidence for avoiding overpriced stocks is very compelling. In a paper called The Case for Value by Brandeis Investment Partners, the firm showed that the lowest decile of price to earnings ratio stocks outperformed the highest decile by 9 percentage points per year from 1975 to 2010. The 7th rule and the second cell rule of the 8 rules of dividend investing is the survival of the fittest rule. This rule states that you need to sell a stock when it cuts or eliminates its dividend. The reason why is because we buy dividend growth stocks to buy steady or rising passive income over time. When a company cuts its dividend, it shows that the competitive advantage is gone and the company is not acting in the best interest of its shareholders. The academic evidence for this rule may be the strongest among any of the evidence presented in this video. Oppenheimer has published research showing that stocks that have cut their dividend have generated a 0% return from 1972 through 2013. The last rule of the 8 rules of dividend investing is our portfolio management rule, which we fondly call the hedge your bets rule. This rule says that when you're employing a quantitative system like the 8 rules of dividend investing, you need to buy the highest ranked stock that you own the least of each month until you've accumulated a diversified portfolio of dividend growth stocks that contains between 12 and 18 securities. There's a wide body of academic research that shows that the majority of the benefits of diversification comes from owning 12 to 18 stocks, which is why we employ this recommendation in our portfolio building guide. Thanks for watching this video on the 8 rules of dividend investing. I invite you to subscribe to this channel and like this video, which will help more people discover ShareDividend's investor education videos. If you're interested in learning more about our quantitative approach to dividend growth investing, check out our website at www.sharedividend.com. I'll see you there.